Your prefrontal cortex actually surrenders 90% of daily control to autonomic reflexes. In 2021, a municipal zoning ledger revealed the exact same hidden architecture, a commercial lease quietly routing shared capital into an unregistered residential property. This investigation begins with a single notarized sublease. A document that mapped a timeline we were never meant to read. Names have been changed. Financial figures have been adjusted for privacy. What remains is a case study in procedural oversight, asset reallocation, and the quiet mechanics of partnership dissolution. The joint venture was structured in late 2018. A standard LLC formation for commercial consulting. We operated out of a shared office space in the Midtown district. For 3 years, the financial architecture functioned as designed. Joint operating accounts. Quarterly tax filings. Shared capital contributions logged in a standard bookkeeping platform. The first anomaly appeared during a routine Q1 2021 reconciliation. I was reviewing the operating expense ledger when a recurring line item caught my attention. Lease payment. $2,400. Monthly. Dated to an entity I did not recognize. The address listed was a commercial designation on paper. I logged into the municipal zoning database on April 12 at 2:15 p.m. The parcel ID matched a single-family residential structure 3 miles north of our operational hub. The discrepancy was minor on its surface. Zoning variances exist. Subletting arrangements are common. I filed it under administrative oversight and moved to the next quarter. But the payment history told a different story. The withdrawals originated from our primary operating account. They cleared on the 1st of every month. They continued for 14 consecutive months. By June 3, the cumulative draw reached $33,600. We will return to this zoning discrepancy in a moment. First, we need to establish how capital moves when oversight is decentralized. I began pulling primary source documents. Not summaries. Original filings. The commercial lease was executed under a power of attorney clause. I did not hold that authority. The signatory was listed as my business partner. The notary stamp was dated November 4, 2020. The property manager listed on the agreement was an individual with a registered mailing address at a P.O. box in the same county. I requested a copy of the original deed from the county recorder on July 19. Processing took 6 business days. When the document arrived, the chain of title showed a transfer from a private trust to an LLC registered in Delaware. The Delaware filing date was October 21. The LLC's registered agent matched the property manager's P.O. box. At this stage, the pattern was no longer administrative. It was structural. I cross-referenced municipal utility transfer logs. On November 18, 2020, the water and electric accounts at the residential address were transferred from the prior owner to the newly formed Delaware LLC. The transfer request was filed at 9:42 a.m. The service activation occurred that same afternoon. Residential utilities do not typically route through commercial holding structures. The zoning classification explicitly prohibited commercial tenancy. Yet the lease designated the space for executive housing and administrative storage. The financial trail extended into property tax records. I accessed the assessor's portal on August 5. The parcel tax assessment was paid in full for the fiscal year. The payment method was a wire transfer from our joint operating account. The amount matched the exact monthly lease draw, compounded annually. The capital was not being spent on operations. It was being reallocated. Quietly. Legally. On paper, it appeared compliant. In reality, it was a parallel funding mechanism. By September 14, I had compiled a 12-page audit trail. The documents were arranged chronologically. The dates aligned with corporate tax deadlines. The capital outflows were perfectly timed to avoid quarterly reporting scrutiny. I did not make a phone call. I did not draft an email. I scheduled a meeting with a forensic accountant on October 2nd at 10 a.m. We reviewed the ledger line by line. The conclusion was procedural, not emotional. The lease was not a mistake. It was a deliberate allocation of joint capital to a privately controlled residential asset. In commercial property and partnership law, this is often termed a constructive diversion of fiduciary assets. It operates within a narrow legal corridor. As long as the LLC remains solvent, as long as the lease payments are documented, and as long as the zoning classification is technically ambiguous, the arrangement survives initial scrutiny. The system relies on the assumption that partners will conduct routine compliance checks. When they do not, the capital flows uninterrupted. By Tuesday, October 12, the bank statement showed 3 additional wire transfers to the same Delaware entity. Each transfer was coded as vendor maintenance. The amounts were precisely calculated to stay below the institutional reporting threshold. I recognized the mechanism immediately. It was not designed to steal. It was designed to accumulate. We will return to the structural implications of this threshold maneuver in a moment. First, the question shifts from discovery to containment. If you were reviewing a partnership ledger at this stage, which anomaly would you flag first for independent legal review? The utility mismatch, the zoning variance, or the deliberate subthreshold wire transfers? Leave a 1, 2, or 3 in the comments. The data set remains consistent across similar filings. Containment requires structural isolation. On November 3, I engaged independent legal counsel to review the LLC operating agreement. The clause governing capital expenditures required dual authorization for any lease exceeding $12,000 annually. The executed lease listed an annual total of $28,800. The authorization log was empty. On November 17 at 4 p.m., I executed a formal notice of capital freeze. The primary operating account was restricted. A new sole proprietorship account was opened. All outgoing vendor payments were routed through a secondary verification protocol. The response was not confrontational. It was administrative. A certified letter arrived on December 1, referencing the freeze and requesting a compliance meeting. The letter was signed by the managing partner. It included a copy of the power of attorney delegation. It cited the Delaware LLC formation as a standard risk mitigation strategy. It requested the immediate restoration of joint access. I did not respond verbally. I filed a petition to dissolve the joint operating agreement on January 14 at 9:15 a.m. The filing included the audit trail, the zoning ledger, the utility transfer dates, and the property tax payment records. The dissolution process moved through standard channels. A court-appointed mediator reviewed the financial architecture. The Delaware LLC was identified as an unconsolidated subsidiary. The residential property was classified as a non-operational holding. The capital reallocation was documented as a breach of fiduciary duty. On February 22, a preliminary injunction was granted. Joint account access was formally severed. Independent property claims were secured through a partition action. The legal framework does not require moral judgment. It requires documentation. The audit trail provided it. By March 8, the injunction took effect. The wire transfers ceased. The joint operating account was placed in receivership. I began restructuring my own financial instruments. I established a separate trust for operational capital. I filed independent tax elections. I secured a new commercial lease under a sole proprietorship. The timeline was clean. The paperwork was complete. We will return to the zoning discrepancy in a moment. The municipal ledger still held one unresolved entry. On April 5, I requested a copy of the original utility service application. The form required a physical address, a contact number, and a signature. The contact number was registered to a secondary residence. The address matched a different parcel. The signature was dated November 15, 2020. The parallel timeline was no longer confined to a single property. The capital had been routed through 3 separate municipal jurisdictions. The zoning classifications varied. The utility providers changed. The funding mechanism remained identical. Joint operating account. Sub-threshold wire transfers. Delaware Holding Company. Residential occupancy. I recognized the architecture because I had helped design it for legitimate commercial purposes in 2016. The system was not broken. It was being repurposed. The realization was procedural, not personal. Financial systems do not generate deception. They amplify oversight. When monitoring lapses, capital finds its own equilibrium. By May 12, the court had approved the final partition order. The joint venture was formally dissolved. The Delaware LLC was placed under independent administration. The residential lease was terminated for non-compliance with zoning statutes. The capital was returned through a structured repayment schedule. The timeline closed. The documents were archived. I retained copies. The audit trail remains accessible. Trust in shared financial architecture does not require faith. It requires verification. The system functions on transparency, routine reconciliation, and documented authorization. When those elements degrade, the architecture does not collapse. It redirects. The zoning ledger did not reveal malice. It revealed a pattern. A pattern built on delayed verification. A pattern sustained by administrative silence. I learned that oversight is not a passive state. It is an active discipline. It requires scheduled reviews. It requires primary source documentation. It requires the willingness to trace a single line item back to its origin. The prefrontal cortex surrenders control to reflex. But financial systems do not operate on reflex. They operate on records. The records do not lie. They simply wait to be read. This case study concludes with a procedural observation. On June 3, a final municipal notice was delivered. It referenced a secondary zoning variance filed under a different LLC. The filing date was March 14. The capital source was a newly established holding account. The registered agent matched the original Delaware entity. The timeline had not ended. It had shifted. The ledger remains open. We will return to this document in a subsequent review. For now, the architecture is documented. The records are preserved. The system continues to operate. And the audit trail remains the only reliable indicator of where the capital actually moves.